There's a retiree in Ohio right now who has never owned a single share of cryptocurrency, never sold his business, never had a foreign bank account. He has a pension, a small IRA, and a savings account at his local credit union. He has been filing his taxes the same way for 22 years. And in 2026, the IRS flagged his return anyway. Not because he cheated, not because he hid anything, because 3 things on his return, things he has always done, now look completely different to an IRS system that has been rebuilt from the ground up to find patterns that humans never could. The IRS is not just auditing more people, it is auditing differently. It has gone from a department that relied on human reviewers and random statistical sampling to an agency running 129 artificial intelligence models simultaneously, comparing your return in real time against millions of others, looking for anything that deviates from what their system considers normal. And here's the part most people are not talking about. This is not a future plan. It is not a proposal sitting in Congress. It is live, right now, in 2026. And the retirees who get hurt are not the ones who committed fraud. They are the ones who did not know the rules changed. Today, I'm going to walk you through the 5 specific red flags the IRS is watching for in 2026. Not based on rumors, not based on what your neighbor told you, based on actual IRS regulatory filings, Treasury guidance, and federal law. Every single item in this video links back to official government sources, and I will give you those at the end. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is John Retires. Every week I break down the IRS rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining in plain English. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me start with the red flag that is going to catch the most people completely off guard this year. I want you to think about the last time you got a 1099 in the mail. Maybe it was from your brokerage. Maybe it was from your bank reporting interest income. You took it to your accountant, they plugged it in, and that income showed up on your return. Now imagine the IRS receives a 1099 in your name that you did not put on your return. That is exactly what is happening in 2026 with a brand new form called Form 1099 DA. DA stands for digital assets. Here is what changed. Starting with transactions from January 1st, 2025, every cryptocurrency exchange in America, every digital asset broker, every hosted wallet provider, every payment processor that handles digital assets is now legally required to report your transactions directly to the IRS. The same way your bank sends a 1099 INT for your savings interest, Coinbase, Kraken, and every other platform now sends Form 1099 DA. And starting in 2026, they are also reporting your cost basis, not just what you sold, but what you paid for it, so the IRS can calculate your gain themselves before they even open your return. Here is the red flag. Every Form 1040, your regular tax return, has a question on the front page. It asks whether you received, sold, exchanged, or otherwise disposed of a digital asset at any time during the year. That question has been there for a few years now. But before 2026, the IRS had no reliable way to verify your answer. They were largely taking your word for it. That is over. If you check no on that question, and a broker submits a 1099 DA to the IRS with your social security number on it, their AI will catch the mismatch immediately. Not in 6 months when a human reviewer gets to your file. Immediately, automatically. The CP 2000 notice, which is an automated IRS inquiry, goes out within weeks. Now I know what some of you are thinking. I have never owned Bitcoin in my life. This does not apply to me. And for a lot of retirees, that is true. But here is why I am putting this at number 1. This is the single biggest expansion of IRS third-party reporting since the 1099 system itself was created. The infrastructure the IRS is building around 1099 DA, the AI matching systems, the cost basis tracking, the real-time cross-referencing, is the same infrastructure they are now applying to every other area of your finances. Understanding it helps you understand everything else on this list. And if you have a grandchild who helped you set up a Coinbase account 3 years ago, or if you received any cryptocurrency as a gift or inheritance, you need to review this with your tax professional before the end of 2026. Every tax return you have ever filed received a score. You just never knew about it. The IRS has used a system called the Discriminant Inventory Function, the DIF, for decades. It is a statistical model that compares your return against the average for someone with your income level, your profession, and your filing status. The higher your score, the more your return deviates from what is considered normal. High enough score, and a human reviewer looks at your file. High enough after that, and you get a letter. That system still exists. But in 2026, it will be rebuilt on top of artificial intelligence. As of early this year, the IRS is running 129 active AI use cases. That is up from 54 just 2 years ago. The agency cut its human workforce by roughly 25%, from about 103,000 employees down to 77,000. But their capacity to find anomalies in returns actually went up, not down, because the AI does the work of thousands of reviewers simultaneously. Here is what the upgraded system is looking for, and this is where retirees specifically need to pay attention. The new AI does not just compare your return to a national average. It compares your return to what is normal for your specific occupation, your specific zip code, and your specific income band. If you are a retired teacher with a pension and you are deducting $14,000 in business expenses on a Schedule C for a side consulting practice, the system knows what other retired consultants in your zip code are deducting. If your number is wildly different from theirs, your score goes up. The red flag here is the 1099K and 1099 NEC mismatch. These are the forms that report freelance income and payment app income. If you sold items on eBay, got paid through Venmo or PayPal for any goods or services, or did any contract work in retirement, there's a 1099 somewhere in the system with your Social Security number on it. If that income does not appear on your return, the AI will flag it. Not because an agent pulled your file, because the system checked automatically. A retiree who collected $8,000 doing consulting work and got paid through PayPal, forgot about it during tax season, and did not include it on their return is not a tax criminal. But they are going to receive an automated notice, owe back taxes, potentially owe interest and penalties, and go through a stressful process that could have been avoided. The fix is simple, and I will give it to you at the end of this video. I want to tell you about a scenario that is playing out right now in IRS enforcement offices across the country. A retired couple, both in their late 60s, lived in the United States their whole lives. One of them was born abroad and still has a small bank account in their home country, left over from before they became a citizen. It earns a little interest each year. They never thought of it as relevant to their U.S. taxes. They have been filing clean returns for 30 years. In 2026, they receive a penalty notice for $10,000, automatically, before any audit, before any human reviews their case, just because a foreign bank sent their account information to the U.S. Treasury and it did not match anything on their tax return. Here's the law. Under the Bank Secrecy Act, any U.S. person, including citizens and green card holders who has a financial interest in or signature authority over a foreign bank account, must file a report of foreign bank and financial accounts, the FBAR, known as FinCEN Form 114, if the aggregate value of those accounts exceeded $10,000 at any point during the year. Not at the end of the year, at any point during the year. That means if 3 small accounts briefly totaled $10,100 when a transfer was passing through, the filing requirement was triggered. Separately, under FATCA, the Foreign Account Tax Compliance Act, you must also file Form 8938 with your regular tax return if your foreign financial assets exceed $50,000. And the IRS gets this information automatically, because foreign banks and countries from the United Kingdom to the United Arab Emirates to India are required by law to report U.S. account holders directly to the Treasury Department. Let me put dollar amounts on what happens when you miss these. Failing to file Form 8938 starts at a $10,000 automatic penalty. If the IRS sends you a notice and you still do not file, that grows by $10,000 every 30 days, up to $50,000. On top of that, any tax you underpaid on those foreign assets gets hit with a 40% penalty, not the standard 20%. For willful FBAR violations, the penalty can be 50% of the account balance per year, or more than $136,000, whichever is greater, and criminal penalties can apply. The red flag for 2026 is this. The IRS AI is now cross-referencing FATCA data, which is the foreign bank reports, against filed returns in real time. The discrepancies they are finding are not complicated tax schemes. They are retirees who have a small account overseas from decades ago who never knew they had to report it here. If you have any financial connection to a foreign country, any bank account, any investment account, any pension from a former employer abroad, you need to review this with a tax professional this year. The filing deadline for the FBAR is April 15th, with an automatic extension to October 15th. Here's a situation I see all the time in the retirement space. Someone retires from their main career and decides to pursue something they are passionate about. Maybe they will start selling handmade furniture. Maybe they do freelance writing. Maybe they buy a small rental property. They set it up as a sole proprietorship, file a Schedule C, and start deducting expenses. And for the first year, maybe the second year, they show a loss. The business cost more to run than it brought in. That loss offsets their other retirement income and reduces their tax bill. The IRS calls this a legitimate business deduction, until they decide it is not a business at all, but a hobby. The hobby loss rule, which the IRS enforces under Internal Revenue Code, Section 183, says that if an activity does not generate a profit in at least 3 out of 5 consecutive years, the IRS can reclassify it as a hobby. And hobby losses are not deductible. If they reclassify years of your Schedule C losses as hobby losses, they can go back and recalculate your taxes for those years, plus interest, plus penalties. But that is only part of the red flag for 2026. The AI upgrade to the DIF system means that Schedule C deductions are now benchmarked against industry and zip code norms more precisely than ever before. Specific deductions that trigger scrutiny include claiming 100% business use on a personal vehicle, home office deductions that seem large relative to your reported living situation, meal and entertainment expenses that run unusually high for your industry, and persistent losses year after year with no apparent path to profitability. I want to be clear about something. These are legitimate deductions if they are legitimate expenses. The problem is documentation. The IRS is not saying you cannot deduct your home office. They are saying that if your home office deduction does not match the size and value of your home, they want to see receipts, measurements, and photographs. They are not saying you cannot deduct business mileage. They are saying they want a contemporaneous mileage log, not something you reconstructed from memory 6 months later. The retirees who get hurt by this red flag are not cheating. They are doing everything they believe is legal, and it probably is. But when the IRS AI flags their return and a human agent follows up, they do not have the documentation to defend what they did. And at that point, the burden of proof is on you, not them. This is the red flag that has been around the longest. And it is still the one that causes the most damage for the most people, because it feels like it should not apply to them. Under the Bank Secrecy Act, any business or person involved in a trade or business that receives more than $10,000 in physical cash in a single transaction, or in 2 or more related transactions, must file Form 8300 with the IRS within 15 days. This is not about banks. It is about anyone. If you sell a car for $11,000 in cash, you must file Form 8300. If you sell furniture at an estate sale and collect $12,000 in cash over 2 days from the same buyer, that likely triggers it. If you are a landlord collecting rent and a tenant pays $2,500 in cash, it triggers it. But here is the red flag that catches people not in business at all. Structuring. Structuring means deliberately breaking up deposits or transactions to stay below $10,000 and avoid the reporting requirement. And structuring is a federal crime, even if every dollar you deposited is completely legitimate income that you have paid taxes on. Depositing $9,500 3 times in the same month instead of depositing $20,500 once, if the reason you split it up was to avoid the reporting threshold, is structuring. The IRS and the Financial Crimes Enforcement Network are specifically trained to look for this pattern. Their systems flag it automatically. The real danger for retirees in 2026 is this. Some people heard years ago that deposits over $10,000 trigger paperwork for the bank, so they started keeping their deposits just under that number as a habit, never knowing that the habit itself is a federal crime. They were not hiding drug money, they were not committing tax evasion, they were trying to save their teller some paperwork, and it can result in asset forfeiture and criminal investigation. Let me put a number on what is at stake. In forfeiture cases related to structuring, the IRS and FinCEN have the authority to seize the entire bank account, not just the amounts over the threshold, the entire account. There have been reported cases of small business owners and farmers losing hundreds of thousands of dollars in accounts that held completely legitimate income because their deposit pattern triggered a structuring flag. If you have been splitting up deposits for any reason, stop and speak with a tax attorney before your next filing. I want to stop here and give you the bigger picture because these 5 red flags do not exist in isolation. They are connected by a single thing that is genuinely new in 2026. The IRS is smaller in terms of people and larger in terms of capability than at any point in its history. With 129 AI models running simultaneously, many of them directly focused on enforcement and audit selection, the agency can now do something it has never been able to do before. It can match every 1099, every FATCA report, every foreign bank disclosure, every Form 8300, every digital asset transaction against your return in near real time. Not sampling some returns, every return. That does not mean every American is going to get audited. What it means is that the returns that deviate from expected patterns are going to get flagged faster, with more precision, and with less chance of slipping through than ever before. For retirees specifically, this matters, because retirement income comes from more places than employment income. You have pension distributions, Social Security, IRA withdrawals, maybe rental income, maybe a small side business, maybe investment income from a taxable brokerage account. Each of those income streams has its own reporting form. Each of those forms goes directly to the IRS. And in 2026, all of them are being cross-checked against your return simultaneously by a system that does not get tired, does not take lunch breaks, and does not forget what it saw. I am not telling you these things to make you afraid of the IRS. I am telling you because the retirees who get hurt are not criminals. They are people who did not know the rules changed, and now you do. Here is the practical checklist. On digital assets. If you own any cryptocurrency or have any account on any digital asset platform, check the box Yes on your Form 1040 and report your transactions. If you do not know your cost basis, contact the exchange. If you have not reported past transactions, a tax professional can help you file an amended return before the IRS contacts you first. It is always better to fix it yourself. On the AI and 1099 matching. Before you file, gather every 1099 you received, including 1099 NEC for freelance income and 1099K for payment apps. Cross-check those numbers against what you reported. If something is missing, add it. The penalty for honest correction is far lower than the penalty for an audit. On foreign accounts. If you have any financial account outside the United States that has ever held more than $10,000 in the aggregate, ask your tax professional about FBAR and Form 8938. The filing is not complicated. The penalty for not filing is. On Schedule C and business losses. Document everything in real time. Mileage logs, receipts, photographs of your home office, contracts with clients. If your activity shows consistent losses, talk to your tax professional about whether you should be restructuring it or establishing clearer profit intent before the IRS reclassifies it. On cash deposits. Stop structuring. Deposit your full amounts. If your bank asks you about a large cash transaction, that is a normal question and you should answer it honestly. The form they file is not a problem for you. The habit of avoiding the form is. Here's something that connects directly to these 5 red flags that almost nobody is talking about yet. The One Big Beautiful Bill, which passed in 2025, created a new $6,000 senior deduction for taxpayers 65 and older with modified adjusted gross income below $75,000 single or $150,000 joint. That is $12,000 for a married couple where both spouses qualify. This is a brand new deduction that most tax software is not flagging automatically for every eligible filer. If you missed it on your 2025 return, you can still file an amended return. But here is how it connects to this video. That new deduction changes your modified adjusted gross income calculation. And your MEDI is the number the IRS uses to determine your Medicare surcharges, the taxation of your Social Security, and whether you hit phase-out thresholds on other deductions. Getting this right can ripple through multiple lines of your return. And with Roth conversions, if you are between 62 and 73 and considering converting traditional IRA money to a Roth, the state you live in and the deductions available in 2026 change what that conversion costs you. I covered that in detail in my video on the best states for retirement income taxes. If you have not watched that one, it is the next one you should watch. Now you know the 5 red flags the IRS is tracking in 2026. You know what triggers them, what they cost, and what to do about them. If this video helped you, hit the like button right now. It takes 1 second, and it helps this channel reach more retirees who need to see this information before they get a letter. If you're not subscribed yet, hit subscribe and turn on the bell. I put out a new video every week breaking down the tax rules and financial traps that protect retirement income. If you know someone who has a foreign bank account, a small side business, or who has been splitting up their cash deposits without knowing why that matters, send them this video. What they do not know in 2026 could cost them real money. And drop a comment below. Have you ever received an IRS notice or been through an audit? What triggered it? I read every comment, and the most common situations in this community become future videos. I will see you in the next one.